Hi, listeners. It's Stephanie Ricca here with a quick note before we get started. Hotel News Now is changing its name to CoStar News, so our podcast name will change too in the coming weeks. Same smart reporting, same hosts, the great guests you've come to expect from us, just a new name that reflects our overall branding change from Hotel News Now to CoStar News. You don't have to do a thing, just keep listening and we'll take care of the rest. Thanks for sticking with us. Now let's get into today's episode.
Hi, everybody. News editor Sean McCracken here with Mark Skinner from the Highland Group. Mark, how are you doing today?
Fine, Sean. How are you?
I'm good. So today I thought we could take a kind of deep dive into the extended stay segment, and there are few people, if any, in the industry more qualified to talk about extended stay hotels than you, Mark. So thanks for joining us.
Thank you for the compliment, Sean.
So let's start just as broadly as we can. What is the current state of extended stay hotels from where you sit?
Well, they're sort of mirroring the overall hotel industry in terms of declining RevPAR, lower rate increases and some occupancy loss. You would have to take out of the equation the luxury segment of the overall hotel industry, which has a negligible amount of extended stay rooms. That is sort of lifting the overall numbers. Mm-hmm. If you look at extended stay on a comparative basis in terms of the same hotel class, they're pretty much going in the same direction. And if you look at the long term, and I'm talking 25 plus years, annual change in RevPAR, the correlation coefficient between the total hotel industry and extended stay is extremely high. Mm-hmm. Obviously the big aberration to that was during 2020 and 2021, where extended stay hotels collectively lost a lot less RevPAR and revenues than the overall hotel industry, especially at lower price points. Yeah. But that sort of correlation has been restored. So what you're seeing is extended stay supply and demand are both increasing, but they are increasing well below their long-term average, which is about 5% over the last 25 years. So over the last trailing 12 months, you've got supply increasing about 2.9%. You've got demand increasing at about 2.5. Over the last 5 months, supply has actually increased faster than demand every month. So occupancy has fallen. But during the prior 8 months, the reverse was true in 7 of them, where occupancy increased. Demand is still increasing. In fact, I think out of the last 30 consecutive months, if you exclude the leap year effect for February, extended stay demand has increased in 29 of those months. But of late, it is not increasing at close to its long-term average of about 5% annually. Mm-hmm. As far as average rate and RevPAR, over the last 2 months, they have both declined for extended stay hotels.
And that's just, like you were saying before, that just mirrors the broader trends in the hotel industry, not anything specific to extended stay, right?
Yes. It mirrors that. And what you'll find during the summer, I mean, we don't really have any performance data for the summer yet, except, the tail end of May, with the Memorial Day holiday weekend in May. But what you find in the summer is that extended stay hotels, especially at lower price points, don't get the tourism boost that the overall hotel industry does. Mm-hmm. That's not their niche. That's not their customer profile at lower price points. The upscale segment of extended stay tends to do relatively well with that clientele. So you usually see a slower increase, or perhaps in this case, larger decrease in RevPAR for the lower priced extended stay hotels relative to the hotel industry.
Mm-hmm. I guess what I'll ask based on what you've described so far is I think a lot of people did take an interest in the segment because of how it diverged from the rest of the hotel industry during the pandemic.
Yes.
And I'm wondering whether you think the takeaway from the correlation kind of restoring itself is that was just a one-off, or is there some sort of the floor is much higher for extended stay? Like what should people really, how should they read into that?
Well, I mean, it was a unique, shall we say, downturn, because it wasn't really caused by economics. It was caused by a health scare, which then subsequently affected the economy. But typically what happens is extended stay hotels look to maintain relatively high occupancy during correctional periods. If you look at the long-term occupancy premium, it tends to range from 10 to 14 points over the overall hotel industry. And during contractionary periods, it usually widens. So what extended stay hotels are doing with that is trying to maintain operating margins. And then when things, come back, if you like, to equilibrium, we all sort of tend to move in the same direction.
Yeah. So I guess shifting gears from performance a little bit, I mean, not entirely, but obviously coming out of the pandemic, even a little bit before that, extended stay was kind of the investment darling of the industry because of the high profitability.
Yes.
Is that still the case in your eyes? And if so, how is that kind of playing into the supply demand dynamics?
Yes, it still does, especially at lower price points. I mean, the profit margins are considerably higher than the overall hotel industry tends to be. So, what you've got, what's happened is you've got this 5 new brands that were announced within the last couple of years.
Is it just 5? It feels like a lot more than 5.
It does feel like, I agree with you, but it's 5, maybe it's 6 now. What is happening is that's where the development activity is the highest. So in our the way we segment the market, that would be occurring in economy and mid-price segments. And if you wanted to sort of pigeonhole, it would be upper economy, lower mid-price, where the action is. But it's important to note that collectively, those 5 new brands, or maybe 6, have only about 2,000 rooms open today. And there are more than 600,000 total extended stay rooms. So that's less than 0.5% of supply.
Yeah.
So it's too early to identify if that is having any real impact on overall extended stay performance, except it has incrementally increased the rate of supply growth. Historically, supply has averaged 5% a year annually. To throw out a number, the last peak in supply was way back in 2009, where it went up 9% in a year. Incidentally, within 2 years, those were absorbed, and that was 2009, 2010 was not a good period for the overall hotel industry. So we won't see any impact on the national extended stay statistics for 18 months to 2 years, as far as we can see.
Yeah.
But what is also, with the focus there in, shall we say, upper economy, lower mid-price, the upscale segment, which used to lead supply growth, has been almost stagnant in terms of supply. There's some other issues that affect that, and that is that there's been disenfranchising of some hotels because they no longer meet brand standards, and the upscale extended stay on average are the oldest. There's been some sales of extended stay hotels to multifamily developers and also municipalities. So the change in upscale rooms has been almost negligible over the last couple of years.
Which is interesting because the kind of investment thesis you've heard a few years ago from a lot of people interested in the segment was it's so undersupplied in general. So the fact that the overall picture is not more stark in terms of supply gains is interesting.
Well, I mean, it's very difficult with the interest rates that they are today and the construction costs to build any hotel, quite frankly.
Yeah.
And that's also impacted extended stay. But it is increasing incrementally. And we've got a much bigger base of rooms now than we had used during the last, shall we say, development wave, which really began in about 2012, 2013. So it's taking longer to build the hotels. There are a lot that are nominally under construction, but over the last 7 or 8 years, as at an average, if an extended stay hotel is reported under construction, there is a 60% chance that it will open within 1 year.
Really?
Nationally, yes. And during the last few years, that chance has actually gone down considerably. It's just taking longer to build. Your entitlements are taking longer. Your construction period is taking longer as well. And now we're seeing it's more difficult to finance a new extended stay hotel today than it was, shall we say, 6 months ago.
I guess it's also, as you mentioned too, it's also worth keeping in mind that there's no really other segment of the hotel industry that supply can so, I won't say easily, but there's a path to kind of exiting the pool of supply for extended stay, like you mentioned with multifamily, that you don't see with really in the same way with other parts of the hotel industry.
That's true. That's true. You had mentioned earlier on about sort of excess demand. Now that still exists. There, in terms of revenues, annual revenues, there is more extended stay demand, and I'll say that is for 7 consecutive nights or longer, housed in traditional hotels than there is in extended stay, even to this day. Now, the question is, how much of that is going to cross over when new extended stay hotels open? And as I said, the development area, we've only had 2,000 odd rooms since the beginning of the announcements of these 5 or 6 brands. So it's too early to tell, just how much more of that demand will move over. I mean, that's what happened over the last 25 years, is that most of the demand in extended stay hotels was staying in traditional hotels, and you've got a new product which is better suited, you have a kitchen, and it moved over. That's collectively now. At lower price points, there's also a significant draw out of the, shall we say, residential market.
Absolutely. It is interesting to me that, I mean, that obviously makes sense. I remember a few years ago when Extended Stay America specifically was launching their kind of segmented, I'm struggling to remember what the names. There was the premier level and the select level, like kind of segmenting out their brands. I remember talking to the CEO back then with the launch, and they even like openly pitched the lowest level as like, this is a great place for like divorced dads to stay. And you know, that obviously would have been demand that went to a traditional hotel, but is much better suited to that type of product, as you were saying.
It is. And in certain parts of the country, which have relatively little lower priced extended stay supply, you find a tremendous amount of 7-night plus business sitting in older limited service hotels. I mean, nationally, it's about 11 or 12% of demand that is for 7+ nights in non-extended stay hotels. In certain parts of the country, it's not unusual to see that double, triple, in an extreme case, quadruple that amount of demand.
So I guess I'll get a little hypothetical with a kind of follow up to you then. If it seems like obviously the demand in this is in the macro sense, I mean, we've seen a dip in the past couple months, but in the macro sense, demand is there.
Hmm.
The supply growth has been relatively muted compared to what we kind of the murmurs throughout the industry and the brand launches and everything. If we get to a kind of more normalized environment when it comes to financing, construction, I mean, and you say normalized, we haven't had what some people would consider a normal environment for a decade now. But if we theoretically got there, would you expect to see an explosion of extended stay supply?
I wouldn't say explosion, but you will see it go up, and it is increasing only incrementally. Though I think the highest monthly increase has been about 3.5, 3.6%, which is still well below the 5. I think that you could see it break through that 5% historical long-term average if we get into a normal situation, shall we say, where interest rates are lower and the financing becomes more available, and you're going into a market nationally where the hotel industry overall is seeing increasing ADR and RevPAR growth as opposed to decrease.
Mm-hmm.
It's almost as if there is a wait and see at the moment. There are developers who are doing extended stay hotels in that upper economy, lower mid price area, but there's also some investors that were looking to get into it that have sort of paused for a moment.
Mm-hmm. And that's just because of the general headwinds that we've already discussed.
Yes, I mean there's concern about cutbacks in travel, how that's going to affect the government. The federal government is a very large generator of extended stay hotel demand. There are concerns. I can't put any statistics to this yet, but they are coming. That there's been a pullback in government and government corporate related demand in certain markets. And that's something that could well have an impact. As I said, demand is growing maybe 1-2% at the most at the moment. Historical long-term average is 5%, and we know there's a lot of latent demand there in non-extended stay hotels. So something is causing the demand to grow slower than it would otherwise.
I do wonder, and I don't know whether you have insight on this or not. I do wonder too, since a lot of the talk we heard around new extended stay brands and just the opportunity in the segment in recent years was tied somewhat to the infrastructure spending from the government that, obviously a lot of construction workers, the type of folks that you would see stay at the kind of lower end extended stay products, and where kind of all that stands now. I know at least data and information on how that money's getting spent is less available now. So I wonder whether that factors into the bigger picture.
Yes, it could do. Oddly enough, I think it was in your publication, or one of them, that I read something strongly related to that. And the report was that construction spending had declined in 9 consecutive months.
Mm-hmm.
And there is that. There is also construction is a major generator of extended stay demand. It's a different construction worker, shall we say, at lower price points than at the upscale end, but it's still a big generator. And you have to also wonder whether any of the immigration crackdown has had an effect too, because at the lower end, a lot of those construction workers are migrating construction workers. So, they move from one bridge construction to the next, shall we say. And if some of that labor has gone, then the demand for the rooms from there will go. So, but again, this is anecdotal at the moment. There will be some some data coming out. I believe Calibri Labs. I've done some research on government demand and government-related demand, which will be coming out.
Mm-hmm. Yeah, all that to say, there's a lot of interesting things going on in the segment. Mark, I really appreciate your time and your insights. Like I said at the top, there's nobody else I'd rather have this conversation with, so I really appreciate you taking the time.
Well, thank you very much, Sean. It was my pleasure, and I've no doubt we'll be speaking in the near future.
Hi, I'm Davon Reed.
I'm Omari Head.
And I'm Chris Henry.
We're the hosts of the Next Gen in Lodging podcast. It's a monthly show in which we interview a new generation of hoteliers to get their insights into a variety of disciplines and topics, from finance to food and beverage and hotel operations. Listen to us on Spotify, Google, Apple Podcasts, or wherever you get your podcasts.
This episode of the CoStar News Hotels podcast was recorded on July 15th, 2025 and edited by me, Sean McCracken. Visit costar.com/hotel news for the latest industry news every day. And if you got a few free minutes in your undoubtedly busy day, feel free to rate and review us on your podcast platform of choice. Thanks for listening.